Franklin Templeton is paying for an acquisition with tokens. The legacy bankers have finally lost their minds.
Tokenized money market shares, Nate, not Dogecoin. They are buying 250 digital and settling on chain. It is actually a highly efficient structure.
Efficient until someone loses the escrow keys. But fine. It is still a rounding error in the $1.2 trillion quarter we just had.
A 26% surge driven entirely by AI panic buying. Let me show you what the term sheets actually say about those mega deals. The rundown?
$1.2 trillion in a single quarter. I had to refresh my terminal 3 times this morning just to make sure I wasn't hallucinating.
Highest number of 10 billion plus mega deals since 2008, which is a completely terrifying year to be comparing anything to, by the way.
Oh, come on, the bankers are finally eating again. Let them have this.
They're eating AI hype for breakfast. Look at the breakdown. A 26% year-over-year surge, and 4 of the 6 largest deals this quarter are literally just tech giants panic buying AI startups so they don't get left behind.
Hey, fear of missing out is a highly legitimate valuation metric.
It is absolutely not.
But the market loves it. Acquirers doing deals over 100 million are actually outperforming their index by 2.5 percentage points right now. Wall Street is finally rewarding boldness again.
Or they're just rewarding the word artificial intelligence in the deal thesis. If you strip out OpenAI and Anthropic getting pumped full of capital, I guarantee that outperformance collapses. You're confusing a tech rally with M&A genius.
Fair enough. But it isn't just tech. Private equity is quietly going wild while everyone else stares at the AI shiny objects. Antin Infrastructure just bought Sapphire Gas Solutions from Apollo.
Which makes total sense. We're hearing non-stop gossip about sponsors plotting take privates right now. Pull a company out of the spotlight, unlock the hidden value, and avoid the public markets entirely.
Exactly. Meanwhile, in healthcare, Premier Radiology Services just picked up Global Imaging Solutions.
Their 3rd acquisition in a row.
You know, I love a boring roll-up play. Consolidating teleradiology is exactly the kind of unsexy strategy that prints money while nobody's looking.
Speaking of unsexy but profitable, Shionogi just bought out all the IP and sales rights for the drug Radicava from Tanabe Pharma. No messy integration, no overlapping middle management to fire. Just pure intellectual property changing hands.
The cleanest kind of deal.
Read the footnotes on that one, though. Valuing pure IP rights right now is a nightmare with inflation risks hanging over cash flow projections.
True, but if you want to talk about valuation nightmares, we need to talk about how we're actually paying for deals now. Cash and stock are suddenly feeling very last century.
Please don't tell me you're getting excited about the Franklin Templeton deal.
I am incredibly excited. They are buying a liquid crypto firm and literally settling the transaction on-chain. The big one. $1.2 trillion. I just need to say that out loud so my brain actually processes it. 1.2 trillion in a single quarter.
Highest number of 10 billion plus mega deals since 2008, which is frankly terrifying if you look at how 2008 ended.
Oh, come on. Don't ruin the vibe. The market is absolutely cooking. Acquirers doing deals over 100 million are beating their index by 2.5% right now. The market is actively rewarding aggressive buyers.
Because it's an AI arms race, Nate. Look at the data. 4 of the 6 largest deals this quarter were purely tech giants, desperately throwing capital at AI startups like OpenAI and Anthropic, so they don't end up obsolete. It's a 26% surge year over year, but it's super concentrated.
Sure, but the AI feeding frenzy is only half the story. Because the most interesting deal this week has absolutely nothing to do with AI. It's Franklin Templeton buying 250 Digital.
The CoinFund spin-out. They're launching a whole new Franklin crypto division.
Exactly. But forget the strategy for a second. Look at the settlement mechanics. They are paying a portion of the purchase price in tokenized money market shares. They're settling an M&A deal on-chain.
I read the press release 3 times because I thought I was hallucinating. It's a historic milestone, sure, but let's be real here.
Don't tell me you hate this. As a former banker who spent hundreds of hours sweating over archaic wire transfers and clearinghouse delays, an instant on-chain settlement is literally the holy grail.
I don't hate it, but it's a gimmick.
A gimmick? It's a proof of concept for the entire future of corporate finance.
Nate, they're buying a liquid crypto strategies firm. The founders of 250 Digital already live and breathe crypto. Try rolling up to the board of a Midwestern manufacturing company and offering them tokenized money market shares. They'll laugh you out of the room.
Today, yes, but someone had to do it first. Franklin Templeton is proving the plumbing actually works for corporate acquisitions.
The plumbing works when both sides are already plumbers. I'll admit the structure is genuinely clever. Using tokenized shares avoids a massive cash drain and keeps the target incentivized. I just want to see if the SEC actually lets this slide into the mainstream.
Watch the ripple effects. Once private equity sponsors realize they can structure payouts like this, it's game over for traditional escrow. They're already plotting aggressive take-private maneuvers behind the scenes right now to pull public companies out of the spotlight and unlock hidden value.
Which brings us to the real hidden value plays. Because while everyone is distracted by shiny crypto settlements and AI valuations, the infrastructure roll-ups are quietly printing money.
You're talking about the Sapphire Gas Solutions deal? Antin Infrastructure just scooped them up from Apollo funds?
Exactly. Let's look at what Apollo is actually doing with all that dry powder. Voices.
I just read this analyst note that completely blew my mind. They are attributing the massive 26% year-over-year surge in deal value heavily to the AI arms race.
I saw that note. 4 of the 6 largest deals this quarter were AI plays.
Right, we hit $1.2 trillion in Q1, the highest number of $10 billion mega deals since 2008. It is a total feeding frenzy for anything touching OpenAI or Anthropic.
But look at the other stat they buried on page 4. Companies completing acquisitions over 100 million are currently outperforming their index by 2.5 percentage points.
Exactly, the market is finally rewarding aggressive buyers again.
No, Nate, the market is rewarding companies that have enough cash to afford a $100 million price tag right now. It is a massive correlation trap. You think they are outperforming because they bought an AI startup? They bought the startup because their balance sheet was already bulletproof.
You are ruining a perfectly good banker narrative with logic again. Stop it. If you do not buy AI right now, the market thinks you are dead.
I disagree. Look at the private equity sponsors. They are quietly plotting all these take-privates to pull companies out of the spotlight. They are not buying AI hype. They are buying boring, steady cash flow. Look at Antin buying a compressed natural gas provider from Apollo.
Sure, but even the boring deals are trying to sound sexy. I guarantee Premier Radiology was pitching AI synergies when they bought Global Imaging Solutions this week.
Teleradiology consolidation is definitely not sexy, but it actually makes money. Unlike half these generative AI wrappers fetching $10 billion valuations.
Fair point. But if you want to talk about a deal structure that is actually futuristic, we need to talk about what Franklin Templeton is doing with their new crypto division.
You mean paying for an acquisition with tokenized money market shares?
Exactly. Settlement is moving on-chain, and it is going to break a lot of legacy banking brains. Spill the tea. I am telling you, the private equity guys are literally salivating right now. They are looking at these public boards getting completely distracted by the AI shiny object, and they are quietly plotting take-privates left and right.
Well, when you have global deal value hitting 1.2 trillion for the quarter, it is hard not to get distracted. We have not seen this many 10 billion plus mega deals since 2008, which, by the way, is always a comforting year to benchmark against.
Ouch, but look at the scoreboard. Companies doing deals over 100 million are currently outperforming the index by 2.5 percentage points. The market is actively rewarding the feeding frenzy. If you are a tech giant and you are not dumping capital into an OpenAI or an Anthropic right now, you are getting penalized.
I completely disagree with that read. The market is not rewarding smart strategy, it is rewarding pure FOMO. 4 of the 6 largest deals this quarter were part of this AI arms race. That is driving a massive 26% surge in deal value year over year, but it is just companies terrified of being left behind.
Terrified or strategic? If you do not buy the lifeboat, you drown.
Buying a lifeboat for 50 times revenue is not strategic, Nate. It is panic. I read the footnotes on some of these term sheets. The structure is basically just throwing cash in a wood chipper and hoping a language model spits out a return.
Spoken like a true skeptic, but you have to admit the actual mechanics of how we are paying for these deals is getting wild. Cash and stock are getting boring.
Oh, you mean like paying for an acquisition with tokenized money market shares?
Exactly. Franklin Templeton is about to make corporate finance history, and my old compliance officers are probably having night sweats just thinking about it.
They better wake up because settling an M&A deal on chain is no longer just a white paper theory. Let us look at what they are actually buying with 250 digital. Tomorrow's radar.
Everyone is obsessing over the Q1 numbers hitting 1.2 trillion. The AI arms race is sucking up all the oxygen.
Right, tech giants panic buying startups. But that is not what I am watching tomorrow.
Let me guess, you are deep in the footnotes on the Franklin Templeton deal.
Obviously, they are buying 250 digital, but a chunk of the transaction is being paid in tokenized money market shares.
Wait, really? They are actually settling an M&A transaction on chain?
Yes, it is a massive structural precedent.
I don't buy it becoming a trend. Large cap acquirers hunting for the next $10 billion mega deal are stressed about inflation and geopolitics. They are not going to start paying for companies with tokens. Imagine pitching that to a board.
You say that, but companies doing 100 million plus deals are outperforming the index by 2.5 points right now. Markets reward creativity.
Creative is one thing. Paying a founder in blockchain receipts is another.
We will see who is right when the full SEC filings drop tomorrow morning.